Hello traders, welcome back once again. In the first part of our chart pattern series, we focused on continuation patterns. And now, here comes part 2 of this 3-part series. As always, a lot of effort has gone into creating quality content for you. So before we begin, make sure to like this video. The target for this one is 1,000 likes. Also, watch the video till the end and share it with your friends and fellow traders. And if you're new to the channel, don't forget to subscribe and turn on the bell notification so you never miss any of our upcoming uploads. Now, in the last part, we discussed 5 different types of continuation chart patterns. However, in this video, we'll dive into reversal chart patterns, and not just what they are, but why they work, and how you can actually trade them effectively. We'll explore the 4 most common and profitable reversal patterns, along with their entry, stop loss, and target criteria. If you don't already know what reversal patterns are, as the name suggests, these patterns indicate that the current market trend is likely to reverse. In simple terms, they signal that the market might take a U-turn in the opposite direction after the pattern is completed. Most of these reversal patterns form during consolidation phases within a trend. It's like the market is saying, "I'm tired of moving in one direction. Now it's time to switch." So in this video, we'll cover 4 major reversal chart patterns and their counter patterns, starting with the head and shoulders and inverse head and shoulders. So without wasting any time, let's begin. The head and shoulders pattern is one of the most popular reversal patterns out there, and because it's so popular, the chances of making mistakes with it are also high. Let's understand what this pattern really means. It consists of 4 main parts: the left shoulder, the head, the right shoulder, and the neckline. Overall, it looks quite simple, right? But what does it actually represent? And why does it matter? Let's analyze it step by step. We'll start with the left shoulder. The initial trend is an uptrend, where prices rally higher. Then the market makes a pullback or correction, forming the left shoulder as the trend temporarily pauses before the next move. At this point, there's still no clear sign that the market will reverse, because pullbacks happen all the time in a trending market. It might simply be another swing low from which the price could bounce and move higher again. Next, the market pushes above the previous swing high, forming a higher high. However, sellers step in, take control, and resist the upward rally, pushing the price back down toward the previously formed swing low. Now, the swing high that formed as a result of this move becomes the head of the pattern. Also, the line connecting both swing lows forms a support level, which we call the neckline. What we can observe here is that the uptrend structure of higher highs and higher lows has now been violated. But even then, we still can't confirm that a reversal will happen, because the price could simply consolidate or move sideways. Once again, from the neckline, the buyers make a final attempt to push prices higher, but this time they fail to even break above the previous high formed by the head. And once again, sellers take control and push the market back toward the neckline. This forms a lower high compared to the previous high, which clearly shows a shift in market sentiment, from bullish to bearish. Now, the only level still protecting the bulls is the neckline, which acts as the last line of defense. If the price breaks below this neckline, that support gets invalidated, and the market could start a new downtrend. So basically, the head and shoulders pattern signals a possible trend reversal as buyers continuously fail to push prices higher. But here's a very important question. Are all head and shoulders patterns worth trading? Actually, no. There are a few key things you must check before trading the setup. The first one is how the pattern is formed, because not all head and shoulders patterns are created equal. And one crucial detail is how the right shoulder develops. For example, if the right shoulder is too long or deep, it's better to avoid trading that breakout. Why? Because when the price moves a long distance from the highs of the right shoulder down to the neckline, it attracts more sellers along the way, which increases the chance of buying pressure from profit-taking and new buyers entering near support. This combination often causes the price to bounce and the pattern fails. So ideally, the right shoulder should be shallow, and it should stay below 50% of the height of the head. Other than this, there are two more key factors to watch for when choosing the best head and shoulders setups. 1. The market structure, and 2. The duration of the pattern. Let's start with market structure. Yes, the head and shoulders is a reversal pattern, but if the overall market is in a very strong uptrend, it's highly unlikely that a single pattern will completely reverse that entire momentum. In such cases, the pattern might trigger a short-term retracement, but not a full-blown trend reversal. So don't bet against a powerful trend just because you see a head and shoulders formation. Now the second factor is the duration of the pattern. A typical head and shoulders pattern can take 200 days, 20 days, or even 20 minutes to form, depending on the time frame you're analyzing. But let's apply some common sense here. A pattern that takes 200 days to form is far more significant than one that forms in just 20 days. And a 20-day pattern is much more reliable than one that appears on a 20-minute chart. Now you might be wondering, why is that? Because when the market breaks the neckline of a 200-day pattern, there are far more traders who would have entered buy positions near that support area, and most of them will have their stop-loss orders placed just below the neckline. Once that neckline breaks, all of those trapped buyers will either exit their trades manually or their stop-loss orders will be triggered automatically, which adds massive selling pressure to the market. Now, if you compare that with a head and shoulders pattern that forms in just 20 minutes, the impact is nowhere near the same. Only a few traders even notice that formation. So the breakout might not generate the kind of momentum you expect. That's why a head and shoulders pattern on a higher time frame, and one that takes longer to develop, has a much higher chance of success. However, this doesn't mean you should jump into a sell trade the moment the price breaks the neckline. There are a few smart ways to trade the head and shoulders pattern correctly. Let's discuss the 4 most common entry methods used by professional traders. Entry technique number 1, aggressive breakout entry. The most aggressive entry happens when the price breaks down below the neckline. The idea is to wait for the breakdown candle to close below the neckline, and then take a short entry just below the close or the low of that candle. The advantage here is clear. You enter the trade early and capture the move right from the start. But the drawback? The market might fake out, giving you a false breakout and hitting your stop loss. Entry technique number 2, breakout with buildup. The second technique involves waiting for a buildup of price near the neckline, a tight consolidation of candles close to the support or resistance area. This buildup shows that the market is preparing for a strong move. Once the market forms that tight range near the neckline and then breaks down, you can enter just below the low of the breakdown candle. The biggest advantage of this method is that it allows a tighter stop loss and provides a better risk-to-reward ratio, which we'll discuss in the next section. The drawback, however, is that sometimes the breakdown candle can be too large, and you might end up selling at a much lower price. Now you might be wondering, what if I miss the breakout? Or what if there's no buildup and the price just continues to fall? That's a valid concern, because buildups don't always occur. In such cases, you can use the pullback entry method. Here's how it works. If the market breaks down without any buildup, wait for a primary pullback, a temporary upward move with weaker candles, often resembling a flag or pennant pattern. This small retracement provides a second chance to enter the trade and allows you to catch the continuation of the down move after the pullback completes. And eventually, if the market makes a pullback, you can look to go short on the break of the previous swing low, or even enter right away when the price begins to move lower. As I mentioned earlier, the best pullbacks are those that have a shallow retracement with small-bodied candles, because they indicate a weak correction and strong selling pressure. But what if we get a steeper pullback with large-bodied candles? What do we do then? In that case, when the pullback is deep, we wait for the price to retest the neckline, or the previous support-turned-resistance level, following the principle of polarity. Here, your job is to observe the retest carefully. If the price moves back to the neckline and then shows clear rejection signs, such as bearish reversal candlesticks like a shooting star, a bearish engulfing pattern, or an evening star, once you see that rejection from the neckline, you can confidently enter a short position on the very next candle. Now, this retest entry technique helps you time your trade precisely and even lets you short the market at a better price. But remember, the downside is that the market won't always perform a retest. And when it doesn't, you might miss the trade opportunity altogether. Another important point to keep in mind is the role of volume during the pattern's formation. The volume should decrease during the development of the left shoulder and the head, which indicates a loss of buying interest. Then, it should increase during the formation of the right shoulder and also during the breakout, confirming a rising interest in selling pressure. So make sure you use the right entry techniques at the right time. Now let's talk about the placement of stop losses based on your entry criteria. As I've mentioned many times, a stop loss should always be placed at a level that, if breached, invalidates your trading setup. Since we're dealing with the head and shoulders pattern, your stop loss should be placed at a point that completely invalidates the pattern. To put it simply, if the price moves above the right shoulder, the pattern gets invalidated. So, if your entry was aggressive, taken right after the price broke below the neckline, then your stop loss should be placed at or just above the right shoulder. Now, if you entered after a buildup near the neckline, you have the advantage of setting a tighter stop loss, preferably just above the consolidation zone. This gives you a much better risk to reward ratio. Let's say you missed both those entries and entered after a primary pullback. In that case, place your stop loss above the highest candle in the pullback group, or simply above the neckline if the pullback forms very close to it. And lastly, if your entry came after a retest, your stop loss can be placed above the highest wick of the retest candles. Or, if you prefer a more conservative approach, place it above the right shoulder of the pattern. Now let's move on to how to exit your trade for maximum profit. There are 3 popular exit techniques you can use: the price projection method, the trailing stop loss method, and a combination approach using both. Let's go through them one by one. The price projection method is a classic charting approach used to estimate where the move might end. It focuses on price exhaustion. Here's how it works. Measure the vertical distance from the head to the neckline, then project that same distance downwards from the neckline. That projected level becomes your price target. The second method focuses on trailing your stop loss to capture big moves and ride trends longer. If you've seen my previous videos, you already know how effective this method is. You can trail your stop loss using moving averages. For short-term trends, use the 20-period MA. For medium-term trends, use the 50-period MA. And for long-term positions, use the 100 or 200-period MA. You simply stay in the trade until the price closes above your trailing stop, and then you exit your position. Finally, you can use a combination of both methods. Here's how. Take partial profits, maybe 50%, at the price projection level, and let the remaining position run by using a trailing stop loss. This way, you lock in solid profits while still giving your trade room to capture bigger market moves without falling victim to sudden reversals. Now let's add a few more important points on when and where to trade this pattern on the charts. The head and shoulders is primarily a reversal pattern, but remember, it also acts as a bearish breakout structure. With that in mind, you can trade it in two key ways. Either when an uptrend is losing strength and this pattern confirms the trend change, or when the market is already in a downtrend and the pattern forms as a temporary pause before the next leg lower. By doing so, you're trading with the dominant trend, not against it. But be careful. Never go against a strong uptrend just because you spot this formation. In those cases, it might fail, and price could continue pushing higher. Now let's move on to the inverse head and shoulders pattern, also known as the inverted head and shoulders or reverse head and shoulders. This is a bullish reversal pattern, signaling that buyers are gradually taking control. It's basically a mirror reflection of the standard head and shoulders, so let's break down its structure quickly. The left shoulder forms as price pulls back during a downtrend, usually from profit-taking or early buyers stepping in. But sellers still control the market and push price to new lows, which forms the head of the pattern. At this point, we notice buyers fighting back with a stronger pullback, a clear sign that selling pressure is fading. Then, when sellers attempt one last push lower, they fail to make a new low, and that forms the right shoulder, indicating that market sentiment is shifting from bearish to bullish. When price breaks above the neckline, the pattern is confirmed, and it often signals the beginning of a potential uptrend. Now, while this sounds great, not every breakout is reliable. What really matters is the strength of the market structure and the time duration of this pattern. If the market has been in a strong bearish trend, a reversal might not sustain. The pattern could just be a pause before continuation. On the other hand, the longer the inverse head and shoulders takes to form, the stronger and more significant it usually becomes. Shorter or rushed formations tend to fail, especially when traded against the trend. Also, pay close attention to how the right shoulder develops. If it's stretched out or too long, avoid chasing the breakout, because by then, price has already moved a long way up and may attract heavy profit booking or short sellers at resistance. This often leads to selling pressure and a quick pullback. A good rule of thumb: the right shoulder should ideally form above 50% of the head's depth. This helps confirm that buyers are still strong and that the breakout has higher probability to sustain. The idea behind the inverse head and shoulders pattern is that it acts as a bullish reversal formation, which often signals a potential breakout to the upside. So it makes the most sense to trade this pattern when the market is already in an uptrend. Because when you trade with the trend, you naturally increase your odds of success. However, there's another opportunity to use this pattern, and that's when it appears at the end of a downtrend. In such cases, the pattern serves as a confirmation that the existing downtrend is weakening, and there's a possibility of a reversal to the upside. But keep this in mind. Don't trade this setup during a very strong downtrend, because in those situations, the probability of a true reversal is quite low. Now, let's move on to how to trade the inverse head and shoulders pattern when you actually spot one on the chart. We'll start with the entry criteria. The most aggressive entry is when the price breaks above the neckline, also known as the resistance level. Here's the idea. Wait for the breakout candle to close above the neckline, and then take a long entry, either above the close or above the high of that candle. The advantage of this method is that you enter very early, often getting one of the best possible entry prices. But the drawback is that it can sometimes turn into a false breakout, and price might reverse to hit your stop loss. The second technique is known as breakout with buildup. This happens when you see a tight consolidation of candles just below the neckline or resistance. Now, this buildup shows that buyers are becoming aggressive, willing to buy even at higher prices despite short-term selling pressure. At the same time, traders who went short near resistance have their buy stop orders sitting above that level. So when the breakout finally happens, these clusters of stop losses act like fuel, pushing the market even higher. Once you see a confirmed breakout, you can enter immediately or wait for the candle to close and then take a long position above its high. The advantage of this approach is a tight stop loss, better risk to reward, and strong entry confirmation. But the drawback is that sometimes the breakout candle is too large, which means your entry price becomes much higher. Now, what if the market doesn't form a buildup or gives a huge breakout candle that you missed? No worries. The third method is to wait for a pullback. This approach lets you catch the move after the breakout has already happened. So if the market breaks out directly, you wait for a temporary pullback, usually seen as small, weak bearish candles. If the pullback forms, you can look to go long either above the previous swing high or as soon as prices start rising again. The best pullbacks are those with shallow retracements and small-bodied candles. But what if you see a deep pullback with large-bodied bearish candles? In that case, wait for the price to retest the neckline, the same level that previously acted as resistance, but now should act as support. When price retests that level, look for a clear bullish rejection, such as a bullish hammer, bullish engulfing, or a morning star pattern. If you spot one, you can go long on the next candle using that neckline as your stop loss reference. This retest method helps you get a perfectly timed entry and often gives a better entry price too. But remember, the market won't always retest the neckline, especially in a strong uptrend, so there's always a chance you might miss the trade entirely. That's how you can trade the inverse head and shoulders pattern using multiple entry techniques, each with its own pros and cons. Yet another important point to keep in mind is that volume behavior matters a lot. During the formation of the left shoulder and the head, you should see a decrease in volume. That's a sign that the selling pressure is fading. Then, during the formation of the right shoulder, and especially during the breakout, the volume should rise, confirming that the buyers are stepping in with real strength. So, make sure you're using the right entry techniques at the right times. Now let's talk about where to place your stop loss. If your entry was aggressive, meaning you entered as soon as the price broke above the neckline, then your stop loss should be set at or just below the right shoulder of the pattern. But what if you entered after noticing a buildup near the neckline? In that case, you can place a tighter stop loss, preferably just below that buildup area. This will improve your reward to risk ratio and help you manage your trade more efficiently. Now, let's say you missed both of those entries and instead entered the trade after a primary pullback. Then, your stop loss should be placed below the lowest price among the pullback candles, including the wick. If that pullback formed very close to the neckline, you can also set your stop just beneath the neckline level itself. And finally, if you entered the trade after a retest of the neckline, your stop loss can go just below the lowest wick among the retest candles, Or, if you want to be a bit more conservative, you can keep it below the right shoulder to protect yourself from deep wicks. All right, now let's move on to how you can exit the trade for maximum profits. There are three popular techniques: the price projection method, the trailing stop-loss method, and a combination of both. Let's start with the price projection method. It helps you determine where the move might run out of steam. Here's how it works. Measure the distance between the head and the neckline. Then, project that same distance upward from the breakout point or neckline. That projected price is your target level, the area where you can plan to exit. This method also helps you decide if it's too late to enter a trade. For example, if the price is already close to the projected target, there's probably not much juice left in the move, and it might be better to skip that trade. Now, unlike the price projection method, the trailing stop-loss technique doesn't use a fixed profit target. Instead, you move your stop-loss as the price continues in your favor, allowing you to ride the trend as long as possible. Here's how you can do it. First, decide what kind of trend you want to capture: short-term, medium-term, or long-term. Then choose your moving average accordingly. Use the 20 period for short-term moves, the 50 period for medium-term moves, and the 200 period moving average for long-term trades. You'll exit the trade only when the price closes below your chosen moving average. The final approach is a combination of both methods. In this strategy, you take partial profits, say half of your position, at the price projection target. Then, you let the rest of the position run using a trailing stop-loss. This way, you lock in profits while still giving yourself the chance to capture a much bigger move without getting caught by early reversals. And that wraps up today's lesson on head and shoulders and inverse head and shoulders. Two powerful reversal patterns every trader must know. Remember, it's not just about spotting the pattern, it's about reading the price story, volume behavior, and timing your entry and exit right. If you found this valuable, smash that like button, subscribe, and turn on the bell, because the next part of our reversal pattern series is going to take your trading game even deeper. This is time to grow. See you in the next episode.